Join us for Selling a Business. Do not forget the tax issues because it's not what you make, it's what you keep. Hi, this is Jim Cunningham, and we're going to talk about selling a family business. Do not ignore the tax issues because it's not what you sell it for, it's what you keep. If you're thinking about selling a business or transferring business equity to a child, really, we're going to focus on the family business, not so much kind of selling to an outsider, although that is part of potentially an exit strategy for a family business. But we're also going to talk about transferring that business to a child. You got to do this right. If you don't pay attention to it, I see too many families, frankly, give too much of the piece of the pie, if you will, to the government. And there are a lot of completely legitimate ways to minimize the overall taxes that a family pays. And we're not just talking about the parents who are the business owners, but if you take a broader view, if you take a multi-generational view, you really do need to pay attention to this creation and preservation of multi-generational family wealth. And part of that is looking at the sale of a family business. So there are significant tax consequences. So I'm a partner at Cunningham Legal, 25 years experience. We have offices throughout California. I'm securities and insurance licensed, as well as a licensed real estate broker and a certified specialist in estate planning, trust and probate law, as well as a pilot. These are the lawyers in our firm. We focus primarily on estate planning matters, tax planning matters, business succession matters, family business matters. And this is our team of lawyers that does that. We do have another webinar coming up, a little bit of an advertisement, financial privacy, like maintaining your privacy in estate planning. Very important. That's coming up next week. This is a disclaimer. I'm going to talk about a bunch of stuff. This is not a do-it-yourself project. This is really part an education. So don't watch this and then just go out and do a bunch of stuff. So we're going to talk about when you sell a family business, we're going to talk about a few things. What is a business? What does that mean? We're going to draw a distinction between an active business and a passive business, right? And you may not be thinking about that, but because sometimes you think, well, that's not really a business, and lo and behold, it is a business. We're going to talk about some various ownership structures, and it's very important that you pay attention to the ownership structure. I tell you, I do meet with a lot of families that it's multi-generational wealth. Many of them have outdated, quite frankly, corporate structures. So they may have a corporate structure that predated LLCs and S Corps. And so you really need to pay attention to this when it comes to passing a business to the next generation or selling that business. We're going to talk about we're going to talk about flavors of sales, different types. You know, there are 4 categories that we'll talk about, and different types of transactions. Estate freezing and wealth transfer techniques, very important. You know, if you have a large estate, if you have a taxable estate, you may be thinking, look, you know, I'm running this business, the kids are in it. How do I kind of shift that wealth to the next generation and minimize death taxes and gift taxes? We'll talk about rollovers, exclusions, and income tax deferral strategies primarily, as well as deductions and state income tax avoidance. So a lot in here. We're going to go through this very fast. This is definitely something you want to do with your A team, which is your lawyer, your CPA, financial advisor, maybe even a business broker or other type of financial professionals. But what is a business? And I really want to draw a distinction between an active versus passive activity. An active trader business versus a passive investment activity. So the best way to explain this is by example. Andy owns a professional services company, right? He does something, professional services. So he's not manufacturing, okay? He owns the office building on Main Street, 123 Main Street. And that office building is in an LLC called 123 Main Street. It's very common to have the address of the property be the name of the LLC. And Andy runs his business, ABC Inc., and has a gross lease on the real property between his business and the LLC that owns the property. Now, I explained to you a very common structure. So if you're a business owner and you own the building, you may have the building in your name and you may be a sole proprietor. You don't have these corporate structures, and you'll see why it makes sense to have these corporate structures, at least if you're in California, to pay less income tax. And we'll talk about AB 150 in a little bit. But this is a classic example of an active trader business. Andy gets up every day, drives to the office, does work. A gross lease means Andy might pay $10,000 a month to the LLC. And then the manager of the LLC, who happens to be Andy, right, also then pays the property taxes and the maintenance and the insurance, and then pockets the balance. So that's a gross lease. That's different than a net lease. And so I'm going to give you the counter example is you've got Baker. So we have Andy and Baker owns a triple net property that owns a Walgreens in Tennessee. It's very common. Triple net means Walgreens pays the rent to Baker. Walgreens pays the taxes, handles the maintenance, pays the insurance, maybe even builds the building or at least maintains the building. That's an example of what is called passive activity. That's also known as mailbox money. So that's where Baker just gets a check every month and he doesn't have to do anything. Walgreens is essentially managing that property. So that's an example of passive activity. These are treated differently under the tax code. It's very important to understand that. And also, Baker holds $5 million in Apple stock. That's passive activity. He's a shareholder. That is a shares in what is called a C corporation. So taxed as C as in Charlie. And we'll talk a little bit about that. So I just want to give you the difference between an active trader business versus passive activity. What are the business structures? How can you own a business? Well, frankly, most people who have their own business, I think most people are probably sole proprietors. So what that means is your income is reported on your Schedule C on your Form 1040, which is your personal income tax return. And you do not have an opportunity to benefit from AB 150. And just to give you a little hint, AB 150 is the state and local tax workaround that allows you not only to pay your taxes at a lower rate, a flat rate of 9.3%, but it also allows you to deduct all of your state income tax from your federal return. So if you're paying $100,000 a year in state income tax, you're going to pay it at a lower rate at 9.3%. You're also going to be able to deduct that. So it's definitely needle moving and something to pay attention to. The S corporation. So corporations, when you hear the term S corporation, and the next slide is a C corporation, something to understand is those are both corporations. And the difference between an S and a C corporation is how it is taxed federally and state. So an S corporation is a pass-through entity. So there's S's in pass-through. That's an S corp. That's how I remember it, right? So this pass-through, this passes through, meaning there's no tax at the corporate level. And we're going to contrast that with a C corporation, which is like Apple. They pay corporate, or at least they're supposed to pay corporate tax, right? And that's been in the news lately. This is a pass-through entity. Something to understand is any profits that the corporation has, even though it's a pass-through entity, California does charge a 1.5% tax on profits for the privilege of having an S corporation. They just say, give us 1.5%. And it's zero tax on your profits to the federal government. And I'll cover an example here in a couple of slides. A C corporation is reported on your 1120C. That's where it comes from. It's the tax return. The state and federal income tax is paid on profits. And there is this, the Inflation Reduction Act that was just passed and signed by Congress does impose a 15% minimum tax on C corporations. It's like kind of a corporate alternative minimum tax, or AMT, but that only affects corporations with $1 billion in profits. So, if you have a C corporation with 10 million in profits, you're not going to be subject to this 15%, at least not yet. So general limited partnership, again, partnerships file a Form 1065. And the reason I'm mentioning these forms is if you have one of these, you go, well, I don't know what I have. If you're filing a 1065, it's going to be taxed. That means that entity is taxed as a partnership. So your income is reported on the 1065. It passes through, so there's no federal taxes paid. So there's no partnership tax that's paid to the federal government. One real big benefit to the partnership structure, and you'll see that LLCs can be taxed as a partnership. So, and we'll get to LLCs in a minute. But one benefit about a partnership is generally real estate is owned by a partnership. That's because you get an adjusted cost basis at death. So what I mean by that is if you hold this property, if you hold shares in a partnership, when you pass away, if those shares in that partnership are included in your gross estate, which is your taxable estate for federal estate tax purposes, if the partnership return on the 1065, they make what is called a 754 election. I know it's a little, granular, but this is a very common thing that people don't really do because they don't have sophisticated enough advisors, or the advisors might miss it. Just, this is truth be told, this is a little bit of a kind of pulling the curtain back and seeing what really happens when people pass away. You do get an adjusted cost basis, but you have to do something on your income tax return for the year that the death occurred. So just something to understand, it is not automatic. It's something that has to be elected, and sometimes people do miss it. Partnerships can also be extremely powerful tax planning tools. So that is the foundation we use for many of our wealth transfer strategies. As lawyers, we use as the chassis a partnership for a lot of reasons. So the other form of ownership is an LLC, or limited liability company. Now, all states have limited liability companies throughout the United States. This is really the most flexible form of business ownership because a partnership requires two people, right? So if you're just one person, you say, well, I can't do a partnership. And you may not want to do a corporation because you may want those tax benefits when you pass away. Remember, if you have a corporation, you do not get an adjusted cost basis on the underlying assets. That's why owning real estate in a corporation typically is suboptimal, because you don't get an adjusted cost basis on the underlying asset. You get a basis adjustment on your shares of the corporation, but not the asset in the corporation. An LLC can be taxed many different ways. An LLC can be taxed as an S or a C corporation, and many of our clients create an LLC and they might opt to have that taxed as an S corporation. We don't see a C corporation too much with an LLC. They can opt to have it be taxed as a partnership, but you need two members, right? You need two people in that LLC in order to have a partnership, or it can be taxed as what is called a disregarded entity. Now, what that means is that for federal purposes, the LLC does not file a federal return. All of that income is reported on your own 1040, but you do file a state return. So no matter what state you're in, you're going to be having some state filing with that LLC, or some level of state filing, whether it's an income tax return or some type of gross receipts tax, or at least some type of registration of the LLC in each state that LLC is doing business in. So you can use AB 150 for an LLC for a disregarded entity. And if I'm throwing a lot of stuff at you, we have a webinar that we just did last week, and it's on our YouTube page, where we do cover what AB 150 is. But AB 150, right now in California and the rest of the United States, you can deduct $10,000 in state and local tax. It's called the SALT cap, SALT, state and local tax. What the state of California did and some other states have done is they say, look, if you're a sole proprietor, you can't do what I'm about to describe to you. But if you have a disregarded entity or a partnership or a corporation, the entity can pay the tax. Okay. When an entity pays tax, it is not subject to the SALT cap. That's a personal cap. Okay. When an entity pays tax, it is deductible federally. So very important to understand it's a business expenditure. But LLCs, the government giveth and they taketh away. The LLC is subject to a gross receipts tax of $800 to $11,790. And that is on the gross receipts. So if you have a business that generates $5 million in gross receipts and you keep $4,990,000, if you're operating on a very thin margin, you probably want to think twice about having an LLC structure, because that gross receipts tax will take all of your profit. So very important to understand it's based on the gross, not the net. So let's look at an example. I would say S corporations are they're great income tax tools. They're great while you're running the business. They can be suboptimal when it comes to selling a business for a variety of reasons. But let's say Andy sells his business, ABC Inc., for $10 million, right? So he's worked on it forever. The asset sale is primarily goodwill, which in many instances, you do have some fixed assets, but a lot of times it's going to be a client list or customer list, contracts, that sort of thing. It's going to be kind of chalked up to goodwill. His tax bill is going to be 20% federal, 13.3% state, plus 3.8% net investment income tax, plus 1.5% California. That's 38.6% tax. Now, I'm assuming this is capital gains tax. But if you have recapture depreciation, that's going to be taxed at a higher rate. And if some of this is income, it'll be taxed at even a higher rate. So 38.6% is a lot to pay in taxes. And this is California. This is combined state and federal taxes. And that's if you have an asset sale. So if you're thinking in your mind, well, if I sell my business, the capital gains tax is 20%. No, you really got to look into this. And this is why it's important. If you're going to sell your business, think about when you're going to sell the business. And if you say, I'm going to sell the business next week, you have a much shorter time period to do tax planning. If you say, I'm going to sell the business in 5 years, that's a much longer period of time. And there's a lot of planning that can be done during that time period. We do have a question, and I do want to answer this question. Anonymous asks, regarding AB 150. If you're married filing jointly, how can the business take the state income tax deduction for my spouse who does not participate in the business? What is actually deducted from the business? Anonymous, we cover that in a prior webinar, but if you're married filing jointly and you have a business, most of our clients have pass-through entities. I'm assuming it's a pass-through entity. It's an S Corp, it's a disregarded entity or a partnership. What ends up happening is you file a tax return on that state level, right? If you're paying state income tax, you would file, if you're doing an LLC as a disregarded entity, you would file the state income tax return. You would report that income as, that's that state and local tax paid. And then you're able to deduct those state income taxes. So very, very important. And if you're married filing jointly, it kind of mashes everything together, even though your spouse is not working in the business. So let's look at the 4 flavors, and these are non-technical terms. There are some technical terms for them, and I got this from a speaker who owns Navix Consulting, Patrick Ungashik. Not quite sure how to spell that, Ungashik, like Ungaschik. So he has Navix Consulting. They consult with people who are looking to sell their business, right? Tax strategies, basic structures. And here's kind of what you need to think about. If you're a business owner and you want to get $1 million for your business, I'm just gonna make the numbers really easy. If you want to get $1 million for your business, the buyer, right? The buyer has to earn $4 million for you to get $1 million. And let me walk you through this. What I mean by this is, if you have a business, you want to put $1 million in your pocket after taxes, what does a buyer have to do? Well, a buyer has to go out and earn $4 million, because 2 million is going to income taxes in California, right? So now the buyer has $2 million, and then the buyer gives you, the seller, $2 million, but you're going to pay half in taxes, 38%, half. If it's income, it's going to be over 50 in California. That's where I'm going. So you go from 4 million to 2 million to 1 million. So it's really important to think about taxes and structures. So what a lot of my clients do, they say, look, I'm going to be well, let's go through these. Transfer the business to an inside employee. This does happen. I think probably the single biggest hurdle, really the first question I ask a client who comes in who's looking to sell their business to an inside person in the company, I ask them, is the person that you've identified, do they have a burning desire to be in business for themselves? Do they have a burning desire to own a business? And this is whether it's your kids or an employee. And if the answer is no, you might have to look at some other alternatives. And an outie is a sale to an outside purchaser. And so when we think selling your business, I think most people think, oh, I've got a business, ABC Inc. I'm going to sell to the person who runs XYZ Inc. and they're going to take my client list or whatever it is, my assets. I think a lot of people think about a sale of a business to a third party. I'm going to get a big check one day. I'm going to get a big check for $10 million. I'm going to keep all that money. I won't have to pay tax, in an ideal world. And then I'll have no further obligation. Well, those really don't, there are a lot of strings attached on a cash deal. So the outie is a sale to an outside purchaser. The passer is somebody who's passing the family business to a family friend or an employee. So I do see passing, in professional services, you will see this kind of frequently, where, whether it's an architect or an accountant or a lawyer or a physician, many times a practice will change hands. But sometimes people will say, look, I'm going to work here, and as soon as I have this much money saved up in my retirement account, I'm giving you the keys to the kingdom, so to speak, right? So you've essentially earned it. So you might say, look, once I have $5 million in my 401k, whatever the number is, once I have that, I will leave and you can have the business. And that is a legitimate way of really extricating yourself from a business, and appropriate in many circumstances, not all. Then there's the squeezer. The squeezer, no sale occurs. The owner squeezes every dollar of value and then closes the business. Again, each of these has their own merits. My father, who's a retired personal injury attorney, did it this way. He worked, and then as his caseload dwindled, he was still getting money from settlements and verdicts or whatever it was, but his staffing went down. So he really made a lot of money in the last few years working because he had cut his expenses. So he had a lot of sunk costs in those cases. So it really depends on what you're doing. It may be that you're going to, you have multi-year engagements with projects. And once the work's done, you have some completion payments that are maybe down the road. It may make sense to really reduce your overhead and maximize the dollar amount that goes in your pocket. So that, again, totally legitimate way to go about selling a business. So let's talk about, within the context of selling a business, something called an estate freezing technique. So the idea here is, if I've got $25 million business and I know I want to sell that business in 5 years and I want to build it and sell it for the biggest dollar amount, maybe I want to sell it for 50 million. There's some estate freezing techniques that you may want to think about before you march down that path of generating more wealth, because it's just going to be paid in taxes. So this is what we're going to talk about. This really works well for passers. This works well for people who are going to pass that business to a family member. You can do annual gifting of 16, you can give shares in the company. That's not going to get you, that's not going to move the needle 16,000 for what we're talking about here. You can do, there are a couple of strategies. One is an installment sale to an intentionally defective grantor trust. Now, why would you ever have a trust that is intentionally defective? It means defective for income tax purposes. So there are two sales that happen. The first sale that happens, so let's say you say, look, I'm going to sell this business in 5 years. It's worth 25 million. We can build it to 50 million, and I want to sell it in 5 years. What you would do is you would say, I'm going to sell this business to this trust for 25 million. It's very high level stuff, right? I'm going to sell this business. I'm going to take a note back for 25 million. That pays me interest at 1 or 2 or 3% or whatever the federal government at that time makes you charge interest, because there's an imputed interest that you've got to deal with. That company grows to 50 million. When it's sold, you get paid your 25 million and maybe plus your interest along the way, or maybe it's accumulated and distributed to you when the sale closes. But that other $25 million profit, that additional wealth that's created, goes to the next generation. It's very important, tax-free. Okay. So what you're doing is you're freezing the value of your estate. You're freezing the value of your company, and you are with an idea of maybe selling it to a third party. And then as that company grows, that future growth in the company, that passes to the next generation. And that's a way to reduce the overall taxes that are paid, that a family would pay, if your mindset is, hey, I want to create multi-generational wealth. And I do want to say something that, I would say money is an abstraction. I think people have different views toward money. Money means something different to me than it does to you. Some people say, look, this is all mine, and I don't want to share anything with my family. And when I die, they can get it and they pay the taxes, whatever. Those tend not to be our clients. The people who tend to be our clients are the ones who say, wow, my basic needs are met. My daughter is a teacher, and we maybe live in LA or the Bay Area in Northern California, and you actually want to see your grandkids. Well, guess what? You might have to help your daughter, right, get a house. You might have to help your daughter, not to spoil her, but because some of these places that people want to live in are just impossibly expensive for most normal people. I'll put that in air quotes. So the other aspect of this is the seller, meaning the seller, the parent, pays the tax and the kids get the proceeds. So what you can do is you can load up the tax bill. If you're going to pay the taxes, right, you can load that up on the parent's side of the ledger, and that's using the grantor trust strategy. Private annuities, kind of similar, but it's not so much of a two-stage sale. It's where the private annuity says, okay, I'll put this $25 million business in there, and then the kids are going to give me a certain dollar amount every year going forward, and for the rest of my life, or a period of years, or whatever it is. So, this can be a little riskier, but this fundamentally is different. This may be where the business is not actually sold to somebody else in the future, but you're able to sell that, and you're able to take that out over a period of time. So rather than taking it all in 1 year, you're able to take these payments out over a period of time and use ideally tax bracket arbitrage. So if your income's lower in future years, those payments that are coming out of the annuity are going to be taxed at lower rates. So that private annuity is another one. Just if you're taking notes, okay, IDGIT, intentionally defective irrevocable grantor trust, and private annuity. So grantor retained annuity trust is yet another technique. So if the sale to the IDGIT says, okay, I'm going to sell it, and there's a note, and there'll be a subsequent sale, and I'll maybe shift some of that wealth to my kids. The private annuity is like, I'm out of here. Here's the $25 million business. give me a note. Another one, the grantor retained annuity trust looks a lot like the sale, right? The sale to an IDGIT, but it's a slightly different variant. I would say this is a very common wealth strategy, wealth transfer strategy. The parents transfer the business to a trust, and in exchange get typically an interest payment coming back, an annuity, right? And it's typically equal to the value of the business transferred. The subsequent appreciation passes to the kids. Now, you can do this and not have that second sale. So in the sale to an intentionally defective grantor or trust, you can have baked in a sale to the kids and then another sale to an outsider. With a GRAT, you may not have that second sale, right? That maybe the kids buying the property. And this is just a way of transferring more wealth to the kids. And maybe they can use that to buy the business from you. So a GRAT, very sophisticated estate planning tool on a very high level. The GRAT says, the grantor retained annuity trust says, I'm putting something of value in here. I'm going to get back 1 or 2 or 3% a year, right? But any appreciation beyond that 1 or 2 or 3% passes to the next generation tax-free. So that's what's going on with the GRAT. It's good if the business is going to increase in value. I will tell you, these were much more powerful when we were in a super low interest rate environment. Interest rates, as you know, have been kind of clicking up and up and up. So you have to kind of overcome that hurdle of the 1 or 2 or 3%. And the reason I'm saying 1 or 2 or 3% is it's changing, right? And it's those are the numbers that we're seeing. So family limited partnership and family limited liability company. So when we talk internally in our firm about a family limited liability company or an FLLC, that just does not roll off the tongue. Internally, we talk about flips, FLPs. It's just easier to say. So there really is no, there's really no difference between a family limited partnership and a family limited liability company when it comes to discounted valuation, when it comes to discounted valuation for lack of marketability, lack of control. We don't really see, I'm not seeing in the cases a lot of difference. And if you're a lawyer watching this and you're like, well, Jim, there's this one case, please let me know, because I'm not seeing a difference. A family limited liability company, in my view, takes less headspace. Okay. A family limited partnership requires one general partner and at least one limited partner. So typically we're setting up as the general partner, a corporation, and then a partnership. So now you have 2 returns. You know, you can make the case why that makes sense. Most people say, look, that sounds like overkill. I want a family limited liability company, generally taxed as a partnership. And so what you do is you take your business interest. Let's say you've got your company that's 25 million bucks. You take the shares of that company and you put those shares into a family limited liability company, voting, non-voting stock. You can make a gift of the non-voting stock. Okay. And again, this is a very common strategy. So you make a gift of stock to the kids, typically in a trust, for a variety of reasons, because you want to keep that out of the kids' estate, right? We're thinking multi-generationally, not just you to the kids. And in doing that, you retain control, you retain all the voting rights. Creditors can't come in and take those assets from the kids, especially if it's in a trust. And this is a mechanism where you can transfer wealth to the kids. And then when the sale occurs, depending on how it's structured, maybe the kids pay some tax at their lower rate. Maybe you're paying all the tax. Sometimes it makes sense to pay all the tax because it reduces the overall value of your estate. So there's less taxable in your estate. But that's really what's going on. And so this allows you as the business owner, if you set up a family limited liability company, allows you to retain control while transferring almost all the business to the next generation. And an ESOP, this is if you're going to, I don't see these a whole lot in my practice. I do see them, and this is a very specialized area. But basically, you can sell your business to your employees, okay? And what you're able to do is you're able to roll over, almost like a 1031 exchange in a sense. You're able to roll over the gains from that sale to certain qualified replacement property, or QRP is what that's called. Basically, these are companies that are operating companies, not financial service companies. So they're not finance companies, but this, it's gonna be like Apple, or it's not gonna be, Wells Fargo, right? It's not gonna be a banking company. So if it's held through your lifetime, the taxes are deferred. At death, if it's included in your estate, you get an adjusted cost basis. So, but I will tell you, if you have any kind of wealth, one of the attributes of wealthy families that we see is many times they have very low cost basis assets because they are given during lifetime. So That's just kind of how it is for many people. Qualified small business stock, QSBS, is the acronym. Very important. You can exclude at least 50%, many times 100% of the gain. If it's a company that you've held for 5 years or longer, it's under $50 million in value, but it's limited to the greater of 10 million or 10 times your basis in the stock. So whatever's greater, right? So if you put 500,000 in and it goes up to, and your stake goes to $10 million, you can sell that free of federal tax, not state tax. And this is the wrinkle in California. California does not recognize QSBS. So if you're a California resident and you've got qualified small business stock, you may want to look at some of the strategies we're going to talk about in the next couple of slides. Then there's a Section 1045 rollover. It allows you, if you sell QSBS, to buy another QSBS within 60 days of sale if you're beyond those limits. So, so here is what, this is a very sophisticated tool, and I'm just kind of throwing this at you because I want you to be familiar with it. I want you to hear it, okay? An incomplete non-grantor trust. Now you think incomplete gift, why wouldn't you want it complete? Well, an incomplete gift does not require a gift tax return, doesn't use up your gift tax exemption. It allows you to shift your tax exposure from a high, and this is a state income tax play, okay? And we do this a lot with QSBS stock for clients. It allows the business owner to shift the gain from a high state tax like California to a zero state tax like Nevada. And we've got a platform set up. We use Premier Trust in Las Vegas. They set up their non-grantor trust. We set up the non-grantor trust. They're the trustee. If it's created in advance, and depending on the structure, now just set aside California source income issues or California source property issues, right? If it's created well enough in advance, usually it's 2 years. That's kind of the magic number. You can eliminate state capital gains taxes. Now in California, we don't have capital gains taxes. It's all 13.3 or it's 9.3 as the ceiling if you use AB 150. So it's something to consider. I want you to hear it, because if we meet with you and you say, hey, I heard about this non-grantor trust, this incomplete non-grantor trust, what's going on? Then we can certainly talk to you about it. But the idea here is this sort of jurisdictional planning, the state income tax is a very big deal for Californians because our highest tax rate is 13.3% on top of the 20% federal, right? New York has really clamped down on this. They don't like it. So if you're in New York, sorry. AB 150, we talked about. AB 150 is the law in California that allows entities to pay state income tax, okay, and receive a deduction. And you can actually overpay your taxes by a lot and get a current federal deduction. Yeah, and when you get your refund, it's coming back into your tax return for subsequent years, but it is fundamentally a bit of a tax deferral strategy, so kind of cool. If you're involved in international sales at all, there's something called an ICI disc, the Interest Charged Domestic International Sales Corporation. Basically, it lets you convert ordinary income to foreign, if you're an exporter, into in a tax saving strategy, and you can also roll in a Roth IRA with that. So we don't see a whole lot of that. We don't have a whole lot of clients that are exporting, but that is something that's out there. So if you are an exporter, something to pay attention to. So that brings us to the end. It's a short one today. If you would like any further information, please reach out to us. We've got a blog article on how to plan for business succession and the sale of a business, as well as our webinar, the Business Succession Planning Essential Estate Planning Tips. That is a prior webinar, and we'll have links in the notes. And our office locations are in Southern and Northern California. We've got a beautiful picture of the Golden Gate Bridge and Southern California. Subscribe to our YouTube page. It's very important. And when you hit the subscribe button, this pops up in your feed. And if you're like my parents and you watch my videos on YouTube, they've never logged into their TV. So I guess you'll just have to remember to check us out. But go ahead and subscribe to our YouTube page. Please review us on Google. In this world of digital everything, it's really important to have really good Google reviews. So if you're a client of ours or you enjoying what we're doing, please don't hesitate to just Google us and write a review, and a favorable one would be nice. And here's our contact information, 866-988-3956. That's anywhere in the US and Canada. You can also visit us at CunninghamLegal.com. Next week, we've got financial privacy strategies in estate planning. So there's a lot of public stuff out there. And maybe your little homework is to Google yourself and see what comes up, which can be kind of scary, but I will open it up for questions. And But please go ahead and subscribe to our YouTube page. And it looks like this brings us to the end. And thank you for watching. Oh, we got one question. Let's see here. If we just close up our small bakery, are there lasting tax implications or benefits? Anonymous, yeah, that's the example. That would be a squeezer. You just kind of run it down. There might be. You probably have some equipment. That's something where I would talk to your CPA. You need to look at the basis of your assets. So, if you've expensed the equipment, if you've got ovens or mixers or whatever you've got in a bakery, that's something where you're going to want to look at that and go, if we sell this equipment, it's kind of a hassle. We don't know if we want to deal with it. You might want to donate that equipment to some type of, food pantry or homeless shelter where they have a commercial kitchen, and get an income tax deduction, right? If you don't want to deal with selling it. But closing a business is a perfectly legitimate way to transition a business and not be the owner anymore. A little overwhelming. Anita says a little overwhelming, but good information. Reason why Cunningham Legal is there to guide down the best avenue. Thank you, Anita. I like that. And Anonymous, thank you. All right, that brings us to the end. Have a great day.